All right. Good afternoon, everybody, and welcome to our webinar on how to find market bottoms. My name is Philip Palumbo. I'm CEO and founder and Chief Investment Officer of Palumbo Wealth Management. I have with us Ed Clissold of NDR Research. NDR Research has been around for 45 years, was founded by Ned Davis Research. Ed's background, he's Chief U.S. Equity Strategist at NDR, responsible for the firm's U.S. equity, style, sector, and equity theme analysis. Ed's market commentary is often quoted in the Wall Street Journal, Barron's, and is often seen on CNBC. Ed is a CFA chartered holder, a magna cum laude graduate in economics from Transylvania University, and has earned his master's in business administration and finance with distinction from Indiana University. Ed, thanks for being on today. Appreciate it.
Thanks for having me. Looking forward to it.
All right, my pleasure. So, for those that are watching, what I want to start off talking about is the great thing about NDR and their research platform is they take both fundamentals and they also take technicals and they tie it together. So what I want to start with, Ed, is talking about the fundamental backdrop environment. The way I've been explaining it to clients is it's like a balance beam, right? So we got the one side that's weighing everything down, which is the tariffs. It's the DOGE to cutting up federal spending, and consumers are slowing. So those situations have been, well, first of all, tariffs have been producing tremendous uncertainty. And what people have to realize is that when you cut government spending, that contracts an economy, and then you have a consumer that's slowing. So that's offsetting the balance beam. And on the other side, which is the hope of the current administration, is that the deregulation, the extension of the tax cuts, and maybe a Fed put, meaning the Fed cuts rates, will offset whatever's going on the other side of the balance beam. The big question is, for all of us, is, what do we think? My personal view is this is a big undertaking, a tremendous undertaking by the current administration that's going to take a lot longer than they think. And because of that, volatility will continue to persist. And I do believe, now today specifically, we don't have a recession. None of the data is pointing towards that. However, I do think the probability maybe has increased now due to this uncertainty that we're experiencing. So I want to first start off, Ed, with you expanding on or any other thoughts you have as it relates to what I just talked about with you.
Yeah, well, I think you hit the nail on the head in that there are a lot of changes going on with the new administration, and some of which will probably be viewed as market positive, some of which over the short and intermediate term may be viewed as market negative, and it's a question of timing. Now, in the first Trump administration, he tackled tax cuts first. That was a 2017 project, and then tariffs were more about 2018. This time, he's tackling tariffs first and then hoping to get taxes done. Now, some of those tax cuts expire by the end of the year, so they're going to have to get something done by the end of this year. So the order of operations has switched some, and so that's one thing we have to take into account. The other thing is, where were we coming into all this? And that is, coming into the election, we had a 2-year bull market. And then for those investors who maybe were on the sideline, which a lot of people have been investing with their political views, which we never recommend because markets go up and down, are Democrats and Republicans. But if there were some people on the sidelines because they're concerned about Harris tax increases, they came off the sidelines. By the time we got to January, we had some of the most overbought levels we'd seen in years. Sentiment from investors was about the optimistic we've seen in years. So any kind of information that was going to ratchet that down meant that probably some people are going to go back on the sidelines. So as you said, we think recession odds over the next few months are very low, but the probability has increased some. And so you have to take that into account. And, that means lower multiples. What that really means is that prices come down. You get a pullback and a correction. So that's how I would frame it. But I think your overall view of what's going on with the administration and the timing of it is really key here.
Yeah, and another thing too that I've recognized throughout my 25 years is that presidential cycles are interesting. In other words, when you had, when Obama came in, he came in during the heights of the financial crisis, markets were at all-time lows, or was at a low period at time, peak to trough drawdown of over 50%, and then there was really good upside from there. And then Biden came in, There's a lot of money left over from COVID and all the spending that we spent within the economy, and then the economy really expanded under Biden. And then, with the current administration, we're coming in at all-time highs, both from a PE standpoint. Economy is pretty much ripping, which is a good thing. So then when you put on top of that the uncertainty around tariffs and the cutting of government spending, you are going to naturally going to get some type of correction with the market like we're seeing today. So can you expand upon presidential cycles, especially the first year in a new term, and what that typically looks like?
Yeah, so look at it from two angles. One is just the price action of the market, and then probably the reason behind that is the amount of government stimulus or lack thereof. And so the first part of a post-election year, the first quarter tends to be a little bit choppy. Then you get a really good Q2 rally, and then the second half of the year can be a little bit more difficult, and that actually bleeds into the midterm year. So kind of what we've seen so far this year is not really all that far out of the ordinary of what you see in the first presidential term. Now, the reason for that is politicians really like to juice the economy, so going into election. So the pre-election year and the election year, you tend to get a lot of government stimulus, particularly from on the fiscal side, a little bit on the monetary side, although they're more independent. But then coming after the election, then they tend to take some of that out. And that really comes out toward the end of the post-election year and into the midterm year. So politicians like to take their medicine early and then move forward, because then voters prefer the good times when they go to the booths again. So what we've seen, what potentially could happen, is actually not that far out of the ordinary. And I'll throw one more wrinkle on this, is that when you're talking about second terms, so instead of just a post-election year for somebody who isn't going to run again, so we're going to make the assumption Trump isn't going to run again, but you tend to get a lot more fiscal contraction. So the NDR, Monitoring Fiscal Policy Index, it's a mouthful, but it's just measurement the Fed's doing and what fiscal policy is. During year fives, there's only been five previous ones since the 1960s. 4 to 5 times there's contraction in that fifth year. So what is potentially setting up for this year, be it from cutting of jobs from the public sector, if you want to call tariffs fiscal tightening, I think that would make sense, and even the deportations. Again, that's probably not directly in there, but that would you're removing consumers, whether you think it's a good idea or not, but removing consumers from the economy. That is kind of what tends to happen at this point in the cycle. So doesn't mean you still don't get corrections, pullbacks, and so forth, but I think it is a little bit helpful to remember that there's a cadence to the market, there's a cadence to the election cycle, and we are following it.
Mm-hmm. So I wanted my audience to first understand fundamentally what's going on, why we're getting the volatility that we're getting, right? Presidential cycles. Then the other important thing I want them to understand before we get into the technical part, which is the bottoming of the market process, is emotions. Without a doubt, the number one reason why investors make mistakes is because their emotions run hot. It's time and time again. It's proven statistically, factually speaking. In my entire career, this is the worst emotional time that I've ever seen for investors, and I understand why. What I mean by that is, the current administration and the rhetoric that comes out from the current administration, it concerns people. And because of that, they think it's doomsday. Now, they may be right, they may be wrong, but just speak to your experience as it relates to emotions in general and what that means to investing.
Yeah, we've done so many studies on this, and in showing that when almost by definition, the peak of a market is when everybody's already invested, because then who's left to buy? You get an incremental bit of good news, and there's no more money to go in, and then vice versa. The bottom of the market is that peak pessimism. So when you get that negative piece of information, everybody who is going to sell already has. And while the reasons each cycle are different. It could be a financial crisis, it could be concern about European sovereign debt. It could be concerns about savings and loans, or the war in Iraq, or you could go back, to tariff concerns in the early 1960s. You could go back and find a reason for the market to be concerned at every point in time. But markets go through the cycles. Eventually, the sellers have gone through their selling process, and markets resume, and you get another bull market. So this, as long as we have people involved, investor sentiment is going to be part of the process. And we're all part of that. We're all, even if we try to tell ourselves we're above it, we're not. And this is why I'm just such a big fan of Ned Davis Research. I was a client before I came to work here, and I just really appreciated trying to having information that can take the emotions out of it. The story I like to tell, the example I like to tell is that there's a book, the New York Times bestsellers, called from about a decade ago, called The Power of Habit. And the author talks about how the part of your brain that governs habit versus emotion are different. And he used the example of Michael Phelps. We all know him. Won 8 Olympic gold medals in 2008 as a swimmer. They said, "Well, how did you do it, Michael? How did you not get overwhelmed by the moment? You're trying to make history. Nobody's ever done it." And the answer is he just had a process. What he ate every morning for breakfast, the warm-up he did, the music he listened to, and the ready room, all of that was regimented. So it wasn't, oh my gosh, I'm trying to make history. It's okay, this is just the next thing I'm doing. And so I think that's what's really great about what we do at NDR is that it's just a process. And then when emotions get high, just follow the process. And that helps you as best we can to take the emotions out of it.
Yeah, and it's like I always say to people all the time, it's like you got to be like a Navy SEAL of investing. You just got to be emotionless and just let processes like NDR and other things that we follow, help guide you, which really makes a big difference. And I've seen it succeed over the 25-year career of mine. The last piece fundamentally I just want to talk about, which we didn't talk about yet, is the AI piece. So, the AI, artificial intelligence, is for sure for real. Now, I think also what happened, so much of the return in the S&P 500 the past 3 years, 2 years, 2 years specifically, has been driven by the top 6 or 7 stocks, the NVIDIA's world, Microsoft, Meta, et cetera. The concern of the market going into this year is there's been an overbuild for AI, and then DeepSeek came out, which was a company within China that built their own open ChatGPT model, and at $6 million cost, where others were spending billions. So the market got concerned that there's this overspend in AI, which doesn't need to be spent, and it continues to be a $300 billion spend estimate for this year. So I think part of the volatility, Ed, besides the tariff piece, the Doge piece, is also the overspend in AI and the concern of that. And also because the big sell-off in the market is attributable to those Mag 7 stocks, which are really underperforming the regular market. Any thoughts on that?
Yeah, I think it's an excellent point. I don't know of any time historically when you could have a group of companies that can at the same time return billions of dollars to shareholders via dividends and buybacks year after year after year, while throwing billions of dollars into an R&D project with no set return on investment that the financial people can model. So they're remarkable companies, first of all. But second, that does create a potential set of concerns if the investment doesn't come back as soon as maybe some had hoped. And then what happens as a result of all that is these companies have gotten so large. So the top 10 stocks in the S&P 500, as of about a month or so ago, were 39% of the S&P. That is a record high. For perspective, during the dot-com bubble, they're about 30%. During the early 70s, the Nifty 50 era, if that rings a bell, that's when everybody said, well, it's 500 good companies. Don't worry about what you pay for them, the multiples, just buy good companies. Well, then they were 34%. So we are well above the two biggest previous periods of market concentration over the past 60 years. And so it doesn't mean these still aren't great companies, but if they run into trouble, which companies inevitably do, that's a market risk. And so that's what we've seen this year. Now, our view on it is that they're under the challenge of the law of large numbers. Their earnings growth has been so good the last few years. It's going to be hard to repeat earnings growth, in the triple digits in some cases again. And so as earnings growth slows, that's when a lot of times, especially these big growth companies tend to underperform, is when their growth rate is slowing down. And so that could be, one of the catalysts. Even if in the long run, AI is valid. So I think that is a unique part of the equation for 2025, the concentration risk, which we've never seen to this degree before.
Yeah, it's an interesting segue into. So Joe Kalish said one time, and I remember, which I thought was fascinating, right? Earnings are a lagging indicator. Market goes first and tells you where things are going, and then it's the economy, and then follows earnings, right? So, and literally in that order. So I want to now shift to technical. So we went through the fundamental aspects of what's going on, why we have volatility. I think that's important for everybody to understand. And the second part is the technical aspect. Technical aspect helps you reveal where we are today. Fundamentals reveals where we should be. So just perspective for all of us, right? We've had a 10% correction from the peak on the S&P and about 14% for the NASDAQ. We have a 10% correction in markets approximately every 12 to 18 months. I think people forget that. We go through a bear market, which is characterized by a correction of peak to trough drawdown of 20% or greater. That happens every 5 to 6 years. When you have a 10% correction, it typically takes anywhere on average a recovery of 9 to 14 months. And when you go through a bear market of 20% plus, it could take greater than 2 years. The quickest recovery we saw was in COVID, which was a 6-month recovery back to peak. And the longest was the dot-com, which was 7 years. So, Ed, the main impetus of this webinar is to talk about the bottoming process, right? Or a bottoming process. We know, history isn't perfect, but sometimes it does rhyme. So what intrigued me to have this webinar was what we spoke about during the call, right? Your 4-step process, 3 to 4-step process of identifying a bottoming process. Now, obviously we want straight down here in a pretty quick time frame. And typically sometimes that means that we can go up just as quick, right? History has kind of shown that. But walk us through exactly how NDR would look at how to find a bottom.
Sure. Yeah. So it's a 4-step process, and those 4 steps are oversold, rally, retest, and breath thrusts. So we'll kind of walk through each of them and kind of bring them into where we are right now. So first one, oversold. I think that hopefully makes intuitive sense. The market goes down, stocks get oversold. For example, you can just see, one way is just look at the percent decline over X number of days. And yeah, as you alluded to, this was a pretty quick decline. So the market has gotten oversold. There's something else called a stochastic, which is a technical term. Just means you look at where an index is, or even an individual stock is, over a certain number of days. Are you near the top or bottom of that? And so using a 14-day stochastic or even 4-month stochastic, we hit one of the most oversold readings we've seen in the last 10 years. So we look at the last 10 years, probably like one of the 5 or 6 most oversold readings. So check, we got oversold. So then inevitably the market's going to rebound. So the rally part of that, you want to look for a broad-based rally. By that I mean you want a lot of stocks participating. And what we see is the stocks go down the most are generally going to be the ones that bounce back, and that's fine. But you also want to see other stocks start participating. Maybe even some of the ones that didn't go down as much. Those need to rally.
And so if I could
a lot of sectors rallying. And
if I could stop you real quick. So we've had this first leg down. So this leg started on February 19th. So first leg down, which was that 10% correction I just alluded to. Right. So that was so basically from February 19th to March 13th was that 10% drawdown. So Friday and yesterday we tried to recover here, right? Which if you look at today, and you could see on the right hand side here, the S&P is down 1.2%, Dow is down 400 points or 0.95%. So it looks like so this is that down move, and then there's a little bit of a reversal here, and then the question is where do we go from here? So I just want to give some perspective for people watching this.
Yeah, that's perfect. Yeah. I mean, you notice during that decline, not very many green bars. Those are up days. And that is a sign of a distinct downtrend, is you only get 1, maybe 2 days in a row. And since that February peak, up until last Thursday, we never had more than 1 day up in a row. And then we got up day Friday and Monday or yesterday. Now, another thing about these rallies is you do want them to last longer than 2 days, because short covering, although the traders who are short in the market, the market starts to rebound, they'll cover their shorts. Those usually be very violent rallies, but also very quick. So you'd like to see signs it's lasting 3 days or more. That tells you there's some real buying coming in. And so far today, haven't really seen that. But we did get some. Friday was a very nice broad rally. So one thing you look at is advancing volume versus declining volume. So that means all the stocks went up on the day. What's their total volume of shares traded? All the stocks went down a day. What's their total volume? If you get more than 10 to 1, that's a really good day. We got a 15 to 1 day on Friday. So that's a very nice, first step to the rally. So we've gotten the rally. So we certainly got oversold, step one. We got into the rally phase, step two. Now, step three is that you almost always get a retest. And a successful retest may or may not include the popular averages, the S&P, the Nasdaq, the Dow, maintaining the previous low. So in some, that actually happens quite often, is that, say, the S&P breaks the previous low by just a little bit, and that kind of spooks everybody. But what's more important is how widespread the selling is. So you look at that declining advancing volume I just talked about. If there's less declining volume than during the initial oversold low, that's a good sign. Fewer stocks below their moving averages, that's a good sign. Fewer sectors making new lows, fewer markets globally making new lows. Those are all really good signs that this is a successful retest. Now, if it's an unsuccessful retest, all the opposite happens, expanding new lows and a lot more downside volume. Then you kind of go back to step one, you oversold again, you look for the rally. So that's kind of the part of the process is sometimes these retests fail. But let's say you do get a successful retest. Then you go on to step four. And those are what we call breadth thrust. Now, that's kind of a funny term. Technical analysts came up a long time ago. But what it means is you get an extremely high percentage of stocks rallying together. I mentioned that 10 to 1 up day we had on Friday. That is one example of one.
Right.
But you can have other things like percentage of stocks above their 10-day moving averages. That gets above 90%. A 10-day total of advancing stocks versus declining stocks, not the volume, just the number of stocks. That gets around two times. That's a good reading. So we have a checklist of those that we follow, and you get several of them. Like, you don't want to have just one, because that could just be a one-off. But you get several of them, and you can say, okay, the selling's over. We've established a new uptrend, and now we can kind of be back in the market with a degree of confidence. So again, the 4 steps: oversold, rally, retest, breadth thrust. It's possible as of today, right now, that we're going through a retesting phase, step 3.
Okay, so my question to you is if we break through on the retest and the advanced decline numbers look off, et cetera, then we could hit a new low. And that means, like you said before, we go back to phase 1. And then we got to then we have to get oversold again, which we are now anyway. We get even more oversold, then we'll rally again. Then we got to go to retest. So the big question is, Ed, are we going to retest and then we're off to the races, back to the upside again, obviously, or vice versa? And I would say, and help me out on this, and I think a lot of that's predicated. I think April 2nd is a big day with as it relates to tariffs. I could see a situation. Maybe it's like, buy on the, sell on the rumor, and then, buy on the news type thing, possibly. So why would a retest fail in your view?
Yeah. So from a technical perspective, just the selling's not done yet. And there could be a lot of times what happens is, particularly if you're going to go into a bear market, there'll be some people during the initial decline that are going to be talking about, oh, this is a pullback. Pullbacks are normal. Ignore it. Buy the dip. And look, this is learned behavior the last 2.5 years, and really the last 16 years, since the 2009 lows. So you kind of have to. That group of people needs to get nervous, and so that can happen. So the market starts to roll over again, and they say, oh, maybe this is a bigger deal. And there's also the fundamentally, what if the tariff news or inflation news, Fed news, or some economic data comes out that says, oh, wait a second, maybe the economy is going into a recession or could be going into recession. Those kind of news events can trigger it as well. But I think you're right about the early April timeframe. It's kind of interesting. Sometimes, again, this is a rule of thumb. these waves down can last about 40 calendar days, and that would put us into early April. So that's something we kind of got on our radar, that this could continue for a couple more weeks. And I think you're exactly right. There's all this fear over tariffs, and then Trump makes an announcement, and it's not great news. Maybe that's the washout, and we go on from there. But we'll have to see.
Yeah. Yeah. Okay, great. This is great, Ed. I really appreciate understanding the four steps, which I think is very helpful. And I do think at the end of the day, it's especially now more than ever, the data is important in terms of the economic data points we're going to see going forward, specifically on jobs and obviously the inflation data. And then with the Fed speaking, I believe tomorrow, and we're going to see what the Fed's going to say. And I think that's going to be interesting. I think we see a hawkish to dovish stance. I don't think he does anything, in my view, in terms of cutting rates. But I do think eventually he will have to cut rates this year at some point. So what I'd like to do now, for those that are listening, there's a Q&A that you could click on. You could type in your question, and Ed and or I will help answer any questions that you have. All right, first question that I have is, how do interest rates and Fed policy impact market stability?
Okay. Good question. There's I think a variety of ways. One is just, companies are borrowing. Those want to buy a house, they're looking for interest rates to see what kind of house they can buy. So lower rates tend to oil the gears of the economy. So that's the main way. Now, there's also another thing with the Fed has becoming so transparent. I mean, it's crazy to think about it. But you go back to the 80s, and the Fed didn't even tell you when they were raising rates. The bond traders would come in one day and go, "Oh, I guess the Fed raised rates. I guess the Fed lowered rates." And now we're tomorrow. An AI bot is going to go through the Fed statement and tell you every word that changed, and they're going to spend a good part of their meeting of their day and tomorrow trying to determine exactly what word they're going to communicate. So the world has really changed, but there is a sentiment impact, and the Fed realizes part of their toolbox is what they are signaling. And so where it can be problematic is if the Fed is really worried about the economy, they're going to cut rates very quickly. And actually that's been bearish for risk assets like stocks, because what's the Fed telling you? They're telling you they've already made a mistake. The economy is going to recession, and they're panicking and trying to fix it. And at that point, it's too late. So a slow and steady pace of rate cuts, which I think I agree with you. 2 cuts this year is possible, maybe a third, but a couple of cuts they maybe cut in May or July, and then one more, after a meeting too. That's actually the Goldilocks scenario, where the Fed is signaling, hey, the economy is in good shape, inflation's coming down, and so we have the ability to oil the gears of the economy a little bit more.
Yeah. So next question I have, thank you, Ed, is this a good time to diversify and invest in international stock given the tariffs, the uncertainty, and EU move to depend less on the US? I just want to take that question quickly, and I want to turn it off to you, Ed. It's really interesting about international investing. Big firms, research out there, been talking about investing internationally for so long because of low PE ratios relative to US. My view and they've been completely wrong, right? And so a broken clock is right twice a day. I think we're seeing international markets outperform our markets simply because they're stimulating more in Europe and in Asia. And I think that's why their markets are advancing. And with the uncertainty here with the high valuations and because of tariffs and the uncertainty around that, that's why we're seeing there's this dislocation with investing. I personally believe, like, the businesses that we own, on average, 40% of their sales are from overseas. So if overseas markets and economies are doing well, I believe those companies will perform well. That's my personal view as I think about international markets. But Ed, I'd like you to take that on.
Yeah, well, I primarily agree with you. Yeah, look, you're talking to the U.S. strategist, so you ask a surgeon, what is he going to say? He's going to say cut. Right. So I'm a big believer in U.S. Exceptionalism. Now, that doesn't mean that the pendulum can't swing too far one way or the other at certain points in time. So a few years ago, the stat I would use about the valuation argument is that really had more to do with sectors. So let's say compare Europe to the U.S. U.S. has a lot bigger weight. That is, like the S&P 500 has a lot bigger proportion of technology, consumer discretionary, healthcare stocks. So these are growth areas that tend to have higher PE ratios because they're growing faster. Whereas in Europe, they have more utilities, energy, financial companies, kind of quote unquote value sectors, which tend to have low PE ratios. So 4 or 5 years ago, once you accounted for the different sector weightings, actually the PE differences between Europe and the US almost completely went away. It was a sector question, not a market question. Now that's not quite true. Even after you allow for the sector differences, Europe's a little bit cheaper than the U.S. And then you throw on the stimulus there. I think you could see European, in general, I'd say developed international, have its day in the sun, and so they could last for a while. But in the long run, the innovation in the U.S., the desire to create new ideas, new products, and the rule of law, and all those things that help an economy innovate and do better, those haven't gone away, and that's why I think the U.S. over the long run will outperform most other markets.
Thank you for that. Another question I have here is one of the newish events with not much of a historic precedent is the spectacular explosion of tariffs. How that may change the historical patterns you described.
Okay, so yeah, so I think a couple things. One is, when you're looking at sentiment and technicals, the beauty of it is it cares more about the what and not the why, right? So that's, and as long as we have humans involved, I do think the sentiment aspect will play out. And then I think the part about tariffs is that, well, it's been a while. I mean, we have to go back pre-Clinton with Robert Rubin as a Treasury Secretary talking about the strong dollars and the best interest of the United States, where they carefully try to avoid being involved in the currency markets before then. And actually, it wasn't that out of the ordinary for the Treasury Secretary to comment on the dollar. And go back to the 80s, there was talk about, is Japan flooding the U.S. with cheap imports, and you go back to the 60s where Kennedy actually imposed some tariffs on steel industries as economies were recovered from World War II, and so maybe we needed to right size some of the trade deals. So it has happened. It's been a little while, and so I think the questions are: one, what's the right level that we're going to end up with tariffs? And if they end up being, extremely high levels, I think most economists would agree that would be bearish, not only for the U.S. stock market, it'd be negative for the economy and negative for the economy globally. So that is absolutely a risk. But if that happens, I would think that like the retest would fail. And then you just keep on having to go back. And that happens from time to time in these major bear markets. You go back to phase one, back to phase one, back to phase one. So that's how it would relate. And then the second thing is that, is there a level which the Trump administration says, okay, maybe the markets are telling us we have gone too far. There's a lot of market practitioners in the administration looking at this. The problem is they can't say it. If they come out and say, well, here's a level in the S&P 500, well, we're just going to change our opinion on tariffs. Well, then immediately you're going to see the market go to that level. So they can't say certain things, and that's what we have to acknowledge when the administration's talking. And that's true. That's true of previous Fed chairs. It's true of previous administrations. It's just how governments have to deal with capital markets. So we have to take that into account as well.
Excellent. And finally, I have room for one more question. How does the firing of government employees affect this market? I mean, I want to just take that on quickly. So a lot of the hiring over the past year or two really has been government, right? So if you have the opposite now, where we're actually firing government employees, I mean, that can contract an economy and cause consumers are slowing already, but now if you have firing of employees, and it's not only just the public sector, but in the private sector, you're also seeing layoff announcements, right? So what is your view overall about that question and the labor market in general?
So the labor market coming into all of this was in pretty good shape. Wasn't nearly as tight as it was a couple of years ago, but pretty well balanced. And we're still adding roughly 150,000 jobs a month, which is consistent with a solid expansion. Now, the layoffs, while they've been, the numbers are pretty big, by themselves. And you're absolutely right. You're reversing the trend where government was a net hirer to now maybe it's not. In the size of the overall economy, it's not huge yet. But the concern, as you alluded to, it's the knockoff effects. Does it move private businesses to maybe say, oh, I'm going to take a step back on my expansion plans? I don't know how all this is going to play out. That's a big deal. And then also the vast majority of government workers are at the state and local level. So we're going to have to see how much of the spigot gets turned off from Washington to the states. If that happens, then you're going to see, I think, a much bigger direct impact of DOGE and federal spending cuts impacting the economy. So, well, the good news is that takes a long time to play out. We're talking about months and months and months, so we kind of get a feel for it. I do view it as a risk. What we've seen so far, in and of itself, probably not enough to cause a recession, but it's something we definitely have to keep an eye on in the months ahead.
And last question, I had to get this question. So what is there a base case for S&P 500 ending this year for NDR?
So coming into the year, we said 6,600, which was kind of in line with the long-term average gain. Our thought was that maybe the economy would weaken a little bit, but you still get okay earnings growth. So that's our basis. We haven't changed it. If you ask me right now, given the disruptions we've seen so far, which I think most people would say Trump administration moved a lot quicker and to a much higher degree than what was expected. And I would take the under on that. But yeah, as of right now, we're in a downtrend. We're gonna have to work our way through it, assuming no recession. The markets have a decent shot to recover.
Excellent, Ed. This was terrific, as I knew it would be. I appreciate your time today and your perspective. It was very, very helpful. And anybody who's listening today, if you have any follow-up questions, please email me, call me. I could always reach out to Ed as well. Thanks for your time, Ed, and thanks everybody for attending. I appreciate it and look forward to seeing everybody soon.